What's up, everybody? It's your boy, Brandon, back with another edition of the Macro Insights podcast. But first, before we get started, a little disclaimer. I am not a financial advisor, and the guest is not giving financial advice. So everything you hear on this podcast is strictly opinion and should not be taken as financial advice. We disclose if we have any holdings discussed in this podcast, and you should not be following us as financial advisors. You should discuss this with professionals before you get involved or invested. And as always, it's not financial advice. So please take this strictly as our opinions and for entertainment purposes only. Now let's get into the show. What is up, everybody? I'm back with another edition of the Macro Insights podcast. And I've got a very special guest here. I've got Tommy Thornton. Tom, how are you doing today? I don't know if you heard my
doing well
in the back listening to me already. Just asking questions for me, I guess, about you. But let's get it started right there. Tell us a little bit about yourself.
Okay, well, I currently live in Greenwich, Connecticut. I've been here for 20 years. I moved here and joined a hedge fund, and I think it was pretty successful for about 11 years, and then it disbanded. That was a story in itself. And then several years back, I really missed doing the same research that I did while at my hedge fund. So I launched a firm called Hedge Fund Telemetry, which basically brings together a lot of different types of research and delivers it via 3 emails a day to subscribers all over the world. And my background, I track market sentiment. I look at technicals using DeMark analysis, other technical indicators, a lot of internal indicators. I have a trade ideas sheet that offers trade ideas, and it's rather popular.
Yeah, exactly. I mean, you've built up a great following on Twitter, and I'm sure on other social media sites and everything like that. But, it is kind of like a unique trend that I feel like has started fairly recently with, a lot of, hedge fund managers or people that have kind of worked in that industry to start, kind of sharing their content, sharing their research and other things like that. So, what was the motivation for you to kind of get started and just, really just putting out your research like that?
Well, I was actually sending. I never really left the markets. I worked for the founder of my hedge fund, his family office, and I still was putting out that same research. And I started sending it to a few friends, hedge fund people. It got around to some pension funds, equity mutual funds, and it started to become a thing. And then one of my old traders, who's our financials trader, told me, he said, "Look, you're not making any money doing this. Why don't you put it out there on Twitter and see if anybody wants it?" And that was 2017. And it really just took off. And it's been really nice. Really enjoy meeting a lot of people around the world. I've tried to keep it at a very cost-effective price for more people to check out and hopefully bring something to their own process. I'm not trying to be the process. I'm trying to show people other ways where they can add to their process, looking at market sentiment, whether it's DeMark indicators or the internals that I look at. I also track short interest. I'm affiliated with another company called Erlanger Research, and we do bi-monthly short interest webinars. So it's just really my joy of looking at the markets, the good days and the bad days. It's just I don't know. I don't want to call it an addiction, but I really do truly enjoy analyzing the markets every day.
Yeah, and we're kind of in an interesting time right now that I think, very few, you're always hearing the headlines, right? Unprecedented time, all this and that. There's a lot of unique scenarios kind of surrounding, not only the market, just the overall kind of macro global economy right now. But it seems like everybody kind of has an opinion on that. So, when you put out ideas, and you're kind of like forward facing like you are, it leaves for people who have differences of opinion and maybe come at it or maybe aren't the nicest in some way. Have you kind of noticed that, or do have you kind of had more, I guess, in-depth and kind of thought-provoking discussions on Twitter and other mediums like that where it's kind of helped you like hone your strategy?
I'll say this: I don't really pay that much attention to a lot of people on Twitter, and I've actually tried to limit the amount of people that I follow, or actually, I follow a lot of people, but I don't look at it as much as I used to. I just keep my head down and do what I do. Of course, you get dissenting opinions all the time, and sometimes when it's always one of my favorite things when I put out an idea and I say I'm buying this or shorting that. Someone will say good luck, and whenever I get that, that's like this offhanded insult, and I know that I'm probably going to be right. It's just a great early sentiment read that is fun to watch. But um, yeah, Twitter's sort of a minefield. I've met a lot of really great people on Twitter. I've blocked a lot of really mindless people as well. Um, I keep my head down. I do the same research I do. It's not going to necessarily make any changes in my life.
Yeah, that's good. You're kind of blocking out the noise, so to speak, and just kind of keep doing the strategy that's got you to where you're at right now. So great, great on you for kind of tuning all that out. But I want to get into the current macro times, right? I alluded to it a little bit earlier, but there's been a lot of crazy things going on. Obviously the massive amounts of QE, the global economy shutting down for multiple months at a time, and the list is almost endless. It seems like these days, but we're kind of in a unique period. So I'm going to leave it a little broad and just ask you, overall, like, how do you view it right now? Because there's kind of, the debate that are we in a recession? Are we not? How this overall strength of the economy and et cetera, et cetera. So I'll leave the floor is yours. I'll leave it a little bit more
Okay.
open ended, but how do you kind of view the current times right now?
All right. There's a lot to go with here. So first of all, the COVID response from the Fed was unprecedented. And yes, there are a lot of times in my life that I've heard unprecedented. And that's partly because they always ratchet things up a little bit more at certain periods. In 1998, when long term capital blew up, it was unprecedented that the Fed stepped in with the big banks and bailed them out. We could look back on the great financial crisis and what the Fed's response was with, direct injections into banks. You can look at QE from Ben Bernanke, that just was sort of global in scale. You can look back on the Europeans and the Asian markets, Japan notably, with negative interest rates, which is still puzzling to me as maybe the worst idea ever by a central bank. So we have that. And then, so going back to the COVID response, I think that everybody was just blown away, not knowing what to do. And the Fed could have done less, but they did too much. And everything is in hindsight, of course. But now here we are with a $9 trillion balance sheet. They have the QT occurring right now, which is 100 billion coming off uh, the balance sheet. Um, it's it, it it's actually excuse me, 100 million billion million. It's mindless to me when I hear people talk about the Fed getting ready to cut rates. Okay, so you have to think that if they're trying to reduce their balance sheet, that is a form of tightening. If they continue to raise rates, that's a form of tightening. But why would they do one versus the other? It just makes no sense to me. I think the Fed has made a lot of very poor decisions over the years. I joke and say that they're really good at fixing problems that they create, and then what they fix the problem with, they have to redo again and again and again, and go through this cycle of more stimulus, um, trying to take it off, but not really. Uh, so the problem I see right now is that the Fed has become too much of a focus in the market, and the market is trying to tell the Fed, no, we want you to cut rates. They've been pushing down the 2-year and 10-year, and the curve is still rather inverted, and I really believe that the market has it wrong. I think the Fed, in their response for fighting inflation, I think the scary thing is that they're making it up as they go, and they'll say something, and Powell, in my opinion, has done himself no favors by really coming out and oh, we're going to have a hawkish message in the statement, and then essentially reversed it all and was incredibly dovish. He did it last, it was in July or August. I think it was late July last, that meeting. And to me, it's that constant walking back, where he's giving the market something to hope for, and they rally the market, and then all of a sudden they have to walk it back, and it's just bad messaging, in my opinion. And this Fed especially, thinks that they are giving the markets really clear messaging, and they're trying to be upfront and say, this is what you should be expecting. They don't want surprises with the market. But the problem that I see is that the financial conditions are looser today than they were when the Fed started to tighten, and that poses two risks. The first risk is that inflation won't come down as fast as hoped, and that is and that's one very likely situation that we're in. The second is, and this is a bigger problem, and I'm not sure if it's going to happen, but I wouldn't put it past anybody right now. The way the markets are reacting is that inflation starts to increase again, and that's not unprecedented. We're going back to unprecedented. The 70s saw several period, the period of high inflation. They saw dips, and the Fed backed off, and then they had to tighten again. That was with Arthur Burns, and he was, looked back on through history as sort of a failure. And I think Powell's going to be looked back at as a failure as well. And that that's where we are with the Fed and that macro scene. So I got a couple more ideas. The dollar. So we've had like one trade. Either the dollar's going up, rates are going up, commodities are going up, stocks are going down, and we've reversed that with the dollar going down. We've had stocks going up, rates are going lower, commodities are sinking. I'm just writing a report on commodities right now. So I think that could reverse, and it didn't look very good for commodities last Friday. It was just a dreary day, and I think the dollar signal. We actually caught the dollar top pretty well, and now we've been, for the last week and a half, been expecting the dollar to have some sort of reversal, and we'll see how far it goes. But last Friday's move was a pretty good first step to see if that can continue. There's a lot of animal spirits in the market right now. A lot of people in the stock market are buying back stuff that was really beat down over the last year. A lot of garbage. I mean, you can look at Carvana, Bed Bath and Beyond. Those are structurally bankrupt companies. They're, up hundreds of percent. You can look at Tesla as one that is up, 90% off the lows. I think these are just reactionary type bounces, and they'll probably start to fade. So I'll go back to you on you can
Yeah.
ask me any questions in between
Yeah,
there.
sure. I mean, that was a lot to unpack there, right? But I mean, it was a great kind of summary as to, where we're kind of at, maybe where we'll be looking back at it in history and everything like that. But I want to get back a little bit to Powell and kind of, his, I guess, role in all of this, because it seems like you said, the market almost seems to be trying to direct him, or seems to be like kind of screaming for a pivot essentially. And in the last Fed meeting, he basically, they raised by 25 basis points, a little bit less than the 75 that they've been doing, the past couple meetings. But in that meeting, he also said that he doesn't plan on, pulling back, or pivoting for the rest of the year. But it seems like kind of general market sentiment is that he's going to kind of go back on that. And you mentioned it a little bit already, where he's been having to backtrack a lot, where they say something and he kind of has to, seems like he's kind of sticking his foot in his mouth in a meeting a few months down the road. So you kind of foresee, I guess, maybe a situation like that with the interest rates policy throughout the rest of the year, where maybe there will be a pivot towards the end? Or do you think that they're going to hold true, just kind of based on a lot of the factors that you were talking about earlier?
Well, I think that they could just stay. They could get to the terminal rate and then see what happens. And that is, we're looking around 5% on the Fed funds rate. Yeah, we could get there. And then their plan was to just stop and see how what happens with inflation, and that gives them the potential to be able to, if they have to raise, um, the Fed funds rate higher to control inflation, then they'll do it. There's the problem I see is, what if they aren't controlling inflation? The stock market is going up, and it's not going to be a beneficial thing for their fight against inflation. We've already seen a lot of job cuts within technology companies. Those are high profile, but we're not seeing it in the jobs data. The jobs data is absolutely as good as it gets. And if someone said the Fed would be raising rates as much as they have, and the unemployment rate would be at 3.4%, I think nobody would have believed that. I still can't believe it. It's super low, but that will start to tick up, and I think that that's the market has had this bad news is good news type situation, but we could start to see, well, we might still see good news on the economy, and that could put a crimp in their hopes for rate cuts. I just don't see rate cuts this year at all. I think it makes no sense. The only way you'd get rate cuts is if there's some sort of dislocation in the market, and the S&P is trading under 3,500, maybe 3,000. From the valuation levels, 3,000 actually makes more sense. And so again, I just, the market going up and people thinking, oh, we'll be buying the market because the Fed's going to cut. I think that's just ill-advised. Don't see that happen. I can't see the Fed cutting rates with the S&P at all-time highs. Just makes no sense to me at all.
Yeah, and I agree with you there too. I don't really foresee them doing that this year as well. But obviously, you have a lot more experience in the market than me. But I also kind of thought that they weren't going to slow down quite as much as they were. Just kind of like based on what Powell was saying, going from 75 to 25. I thought maybe this one, obviously, as it got closer to the event, it seemed almost like a guarantee that they were going to raise by 25 basis points. But I thought, in that in between time, I thought, maybe that they would raise by 50 or so. But you brought up the unemployment data and everything that kind of comes along with that. It seems like unemployment or layoffs are making a lot of headlines, especially when it comes to the tech sector. But there's been like kind of a lot of, maybe debate back and forth, or at least that from what I've seen, as to, maybe not necessarily the validity of the data or anything like that, but a lot of these jobs and these layoffs from the tech sector, it seems like a lot of them have been able to get, reemployed within 2 to 3 months, or at least that's kind of seems like average. Like anecdotal stories I'm hearing all over Twitter are people are getting laid off and then going to another job where they're getting a big pay and other things like that. So do you still kind of see, I guess, this unemployment data being kind of a lagging indicator, and that it's going to go up kind of throughout the year as planned? And I guess, yeah, now the floor is yours. I'll let you have that one.
Well, I just want to go back one thing. It's possible the Fed downshifted to 25 basis points so they can keep doing 25 basis point hikes. And I think for March, it's a given that they're going to do that. The next meeting is 6 weeks later. I think it's early May or maybe late April. I'm sorry. It's a Sunday. I haven't had enough coffee. But I think that if anything, they may have downshifted so they can continue to do 25 basis point hikes longer to continue to put off the inevitable rate cuts. So that may be their basis of why they're downshifting. As far as the unemployment rate, so one thing that I always tell people, watch the jobless claims data around the 12th of every month. And so that's next week's numbers, because they do the survey for the non-farm payroll and the unemployment rate. Those are totally separate reports done by two different organizations. So that's when they do the survey. We've seen such low jobless claims that every time I see one, it comes out and it's under 200,000, it's just like I blush because it's so good. But I think that is, I think you're going to see unemployment continue to go up. I think you're going to see, and I can actually see 5% unemployment, which is a very low number. But the problem that typically happens is once unemployment starts to go up, it continues to go up for quarters, not just 3 months. It's going to go up probably for a year. And the other thing that in the data that was really surprising is the wages continue to stay very sticky. So wages are really, really strong. And that, I think, is something the Fed's watching, and they can't do a whole lot. One other thing with the Fed that I kind of thought about is maybe maybe Powell was being so dovish because he thinks that transitory inflation is actually still in play. Maybe he thinks that, okay, it's coming down, the S&P is staying bid, jobs are good, wages are steady, but unemployment's or the CPI's drifting down. You've got energy prices lower. You've got, maybe we'll see rents come down. There's a big adjustment that they're going to do for rents that will basically lower CPI and undercut the amount of the shelter and rents that was used in the CPI calculation. So that's, whenever they change the rules, it's kind of like, so maybe that's his plan. Maybe he is fine with the market going up. Maybe he thinks that, okay, we'll be okay with a 4% CPI and inflation rate. Maybe just we'll do it longer, and year over year it'll start to look better. And maybe that's his plan. I don't know, but I just think that if anything, it is hurting the economy. It will hurt the economy. It will hurt consumers. And if you look at the M2 numbers, as far and savings rate numbers, um, there's still cash in a lot of people's bank accounts, but unfortunately, that's starting to dwindle down because you're seeing credit card usage increase for staples and energy bills and things like that. That typically is not a good sign.
Yeah, and you kind of nailed it on the head there with the credit card, being almost at I think at like an all-time high with credit card debt in the United States, and personal savings being extremely low these days as well. So, when it comes to the consumer and kind of that like cog, I guess. How are you kind of like analyzing that as to are you using that to kind of help gauge the strength of the economy and kind of gauge like where we're at in this cycle? Because it seems like the consumer is hurting somewhat, with all these kind of like indicators, but it seems like like you said, that the stock market is still doing fine. We're having a lot of companies kind of rally and having a big jumps, but I guess, do you think that this is kind of just a sign of maybe a little bear market rally, and that eventually we're gonna kind of come back down and get back to earth a little bit?
Yeah, that might have started last Friday with the market pulling back. I, I just started shorting home builders, and home builder stocks are just on a tear. And if you listen to their conference calls, they made their numbers this last quarter, and with lowered guidance. They reported cancellation rates and new order rates that I've never seen so bad in my life. And the economic data, when you see the new home sales, pending new home sales data come out, that is actually skewed because that is when a consumer or family or whoever buys or puts a deposit on a new house. So they go to KB Home and they say, okay, I'll buy this house, sign me up. That gets noted as a pending home sale. When they cancel, because they can cancel at any time before it's done, that data doesn't get taken off of the pending home sales. So it's, I think, a bit skewed at this point right now. There's a lot of supply, a lot of housing, or a lot of houses that the home builders built and are completing, and they, they had they had really a terrible situation where they built these homes with higher labor costs, higher material costs, and now you have higher interest rates. That I still think at 3.5% on the 10-year, it's still a lot higher than what the average consumer has been uh, paying for their mortgage. And the other thing is, consumers are sort of stuck in their home, their current home, and there's not going to be a lot of upward mobility to move to a new house because, to give the Fed credit with all that low interest rate, ultra low rates for the last 10 years, if you bought a home, you have a 2% mortgage, a 3% mortgage, and who wants to pay 6%? Nobody. It's a real, you're really going to have some sort of higher income that's going to, fill the delta there. So I think that people are not going to sell their house because they don't want to go out and buy a new one. They might be able to afford it, but the mortgage is going to be more just because of the interest rate.
Yeah, and you brought up an interesting, part of the overall economy right there, right? Housing, right? I mean, it's just going to be, between like home builders and just like new people, like you said, like personal mortgage interest rates skyrocketing. And I know anecdotally a lot of people that are, somewhat trying to wait, to quote unquote time the housing market, because they think that interest rates are essentially going to have to come back down to what they were during 2020, where there were between 2 and 3%. But personally, I don't think that they're ever going to get that low, maybe ever again, just because we're seeing kind of how inflated housing got and everything like that. But I guess overall, what kind of signals do you look at, when it comes to the housing market and things like that? Because you talked about like new home sales and the personal mortgage rates, but it seems like housing's always kind of a lagging indicator, and I feel like it seems like it's kind of turning around just anecdotally. I'm in Tampa. It seems like, that from what I know from realtor friends and everything else, that it's starting to kind of heat up again. And I don't know if that's just kind of seasonality or whatnot, but what are some of the things that you're looking at as far as just, diving into the housing market?
Right. Well, I think it's been a really slow 6 months because of rates moving higher. There's been a lot of uncertainty. The equity markets have been terrible, and people are. I think people and companies have held off making big decisions, and that's been the last 6 months. So there's a little bit of pent up. I want to buy a house, or I want to buy stocks. A little bit of that right now. The one indicator I do look at when it comes to housing, and I think it's really the most important, and it hasn't deteriorated, is the unemployment rate. So if we start to see unemployment go up, most of the time people, if they're unemployed, and they stay unemployed for a certain amount of time, they sell their house or they lose their house. You can look at the earlier types of indicators versus a house, and you can see auto delinquencies, the auto debt or car payment delinquencies have spiked. The repo rates, repossessions have been off the charts, and I think that's a real concern as well. So if you start to see those things, usually leads into other stress for the consumer. And to be quite honest, and I'm really surprised that the consumers held up as strong as they have. The other thing that has really been a big focus is demand, and I think this is really important from the macro stance. When the Fed raises rates, their job is to hurt demand. I mean, crimp demand and make it harder for people to purchase and buy things for whatever reason, and companies, and that's been somewhat muted. But I think that like I'm looking right now at Apple and Tesla, and they are big players in China, from their production to their consumers in China. And now that you have China reopening, which is also an inflationary event, or should be, um, unprecedented, you're going to have a clean quarter. So this is Q1 is going to be a clean quarter where you're going to have the supply chains working, you're going to have China reopened, and now you're going to have to test the demand of your products. And are iPhones selling enough? Are Teslas selling enough? There's signs in the channel that you can get an iPhone. You walk into any store, you can get it. It's not that hard to get. There's signs that you can buy a Tesla immediately. There's lots of inventory. Those are the things that they've lowered prices here and there. I mean, I had to get a new iPhone because I dropped mine, and I got $1,000 back from the broken phone that I have, which I was like, I didn't ask for that, but that's nice. It wasn't broken that bad, but the Tesla lowered prices. They did it to clear inventory as well, to get some tax credits for the consumer. But lowering your cost or your prices will hit your margins, and Tesla's had good margins, so that's going to be all in play here in Q1. So Q1 earnings, I think, are going to be really, really important, and you're going to have a lot of them that we've had this quarter. It was better than feared. Apple was better than feared. Okay, well, it's Q1. It's reopened. Supply chains are fine. Let's see what your demand's like this quarter, and I think that's going to be the real tell.
Yeah, so we've kind of gone over like the current situation. You talked about some of the things that you're looking at, especially this upcoming quarter with a lot of earnings, right? The kind of supply and demand aspect and other things like that. Like, are these companies kind of able to as all these quote unquote inflationary events are happening. Like, are they still, keeping up with demand and other things like that? So, but I want to get to a little bit, I guess, more of a forward facing question, or a future outlook question. What is something that you're going to be looking at that's, going to be your sign that maybe the economy is kind of flipping around, and instead of this doom and gloom where we're seeing it either go downwards or something like that, maybe we're in a recession. We could, I guess, that topic's in debate right now, depends on who you ask and whatnot. But what are some of the indicators that you're going to be looking at down the line that maybe you could point to and say, like, all right, once it hits X amount or something like that, that I kind of see the economy turning around?
Well, there's the soft landing versus hard landing debate on as far as, and then will we go into a recession or will we not? And I think it's it, you usually get a soft landing and then you get a hard landing because it, I said it the other day, like you landed on a plane and you're going down the runway and it's all fine, but the plane doesn't stop and goes right off the runway. That's a hard landing. So the problem is, we I don't know. I don't know if we're gonna get a landing actually, because I feel like the economy just continues to chug along. Jobs are still good. You're still seeing generally good earnings. Nothing. I mean, this is not necessarily a banner quarter that we've just had, but it's not a disaster. The stock market's still holding up. Unemployment's fine again, and so maybe we're not landing yet, and I don't see inflation as the thing that's gonna do it overnight. I think it's gonna take probably 6 months, if that, to get unemployed or get inflation, the CPI, under 4%, if that. And so my view is sort of, I can't really say if we're in a recession or not. I don't think we are technically. I mean, a lot of people vary on the way they measure inflation or recessions now, but it could happen maybe later in the year, and that is when I think that the self-awareness part for the market participants are going to start to wake up and say, you know what, it's worse than expected. It like this Q1 in April and May, are the earnings, are they getting better or are they getting worse? If they continue to stay not so great, and let's look at like Amazon's AWS, their Amazon Web Services. It's their key business. It was growing at 40% a year ago. Expectations was this quarter to be growing at 28%. They missed that, and expectations for next quarter was for 24%, and they lowered it to 20%. So that's a big deceleration of growth. And if that continues and we're in the teens, what's to say that this goes into a no growth period? Apple's numbers weren't great either, and I can't really say that if you look at a lot of the data, they're not really growing. They're actually still it's a brilliant company. Their cash flow is actually it's steady, but the amount of money, cash versus debt, because of their buybacks, is starting to dwindle. I'm not concerned about that, but the big point is, the longer we go where it's not growing is the non-landing period. So everybody wants to land and move on and everything get better immediately, and that's the immediacy of the generation that we're in right now. It takes time, and even if you go back to 2000, 2001, when we really peaked, and this is sort of a similar period where we had a tech get blown up in Q4 2000, and tech came roaring back in early 21 or 2001, and then really, fell apart for another couple of years. So that may be the landing. It just may take longer. And we'll see if we get that soft landing. And if the plane can't stop, then it's a hard landing. And then we got all sorts of other things. And then maybe the Fed will cut rates.
Yeah, right. It's like very reactionary, it seems, at this point, where it's like, they're getting all this data and then they're kind of looking at it, and it's all, backward facing or kind of lagging indicators, so to speak. So it seems like once the Fed kind of decides to maybe pull back or pivot or whatnot, it's probably going to be a little bit too late, or at least that's the way it's been seeming so far, right? I mean, everybody can kind of play Monday morning quarterback and look back at what they've done and kind of point to mistakes that they've made throughout this way. But so I guess you brought up tech because we've seen like a big giant boom in tech, and whether it's Tesla, Apple, or not even Apple, but some of these other, stocks that have seen increased volatility. And then we've also seen, you brought up Bed Bath and Beyond. We had the GameStop kind of fiasco during COVID. So it seems like there's been a lot of volatility in the market, and a lot of it's either, based on retail kind of coming in or big booms in tech. So, as tech has been kind of one of the industries that's been hurting lately, do you kind of still see, a lot of volatility kind of heading that way in, the tech sector, or, maybe, I guess, still some room for stuff like Bed Bath and Beyond or GameStop to kind of still happen, where it's just unexplained volatility and you see, stocks kind of not really making too much sense based on, the earnings and everything else?
Yeah, there's a lot of stuff that I can look at and say it really doesn't make a lot of sense. And there's this casino-like mentality that we are back to, that we had in 2020 and 2021, and it's the short-term zero data expiration option volumes are just incredible, and it's not just retail buying out of the money calls in Tesla or Nvidia or something else. It's institutions doing the same thing, and I'm not a fan at all of having expirations for futures every single day. It makes or S&P futures or SPY QQQ options every single day, and I'm waiting for them to start opening it up on the weekends. The problem is that it's causing these really wide swings with the dealers. The dealers are the option traders at the banks and the brokers that basically they have to delta hedge position. So if someone comes in and buys a lot of out of the money options that expire Friday for Tesla, they have to buy a delta weighted amount of stock. And if that continues to go up, they have to continue to buy more stock to hedge out the potential for that option. And if that option out of the money doesn't get nailed or surpassed, then those option buyers have to sell or they expire worthless. Thus, the delta weighted hedges get sold down as well. And we've seen that a lot. You can almost see it intraday. There's a couple sites that really do a great job at highlighting that action. And the other thing is, if we've seen this just massive amount of call buying, and last week's action was like the 99.8 percentile of highest call buying ever in 1 week. There's a lot of talk about short covering as well, and we're pretty plugged in on that. And I'll say that there's been a lot of short covering, and I'm looking. Wait, hold on. I can tell you I have the screen here. The last 5 days, the Goldman Sachs short interest or the most shorted basket is up 10%, and the last 5 days the S&P is up 1.6%. So there's been a huge short squeeze. But the one thing that what we've noticed is there weren't really that many people short because hedge funds are not necessarily that exposed as much as you'd think watching the action. It's just they have really low exposure historically in the markets. They just haven't come back. And when they come back, they have to, if they're long short, which is what I did, they come back and they add shorts, add longs, and add exposure together. So their net exposure is still pretty low. But I think it hit a level where it was this week, where it was in August after that last peak in August. So at like 46%. So it's not, not too high. So that's kind of the craziness of with the casino mentality, the short-term options. It's just an accident waiting to happen, and I'm not quite sure who's going to be exposed to that. I think most likely it'll be retail traders that end up, burning their capital, trying to, hit it on black, and that's the problem.
Yeah. So I mean that was great. Kind of the overall just like kind of yeah, like casino mentality, it seems like, right? I mean, we had the stocks only go up, like all that kind of stuff for the past couple years. So it does seem like there's a lot of exposure to that in the market and everything like that. And it microcosm is we're seeing basically a bunch of volatility, seemingly because of it. But Tom, you've been great and very generous with your time. So I really appreciate you coming on the show. I feel like there's definitely room for another conversation for us to have down the road. So, you're always welcome to come back on. But why don't you tell everybody what you got going on and where they can find you?
Okay. Well, thank you for having me, and definitely let's do this again. Please let's find me when the market's at its most volatile, and you might even catch me leaning a little bit more on the bullish side. So that would be great. So I am Tom Thornton. Hedge Fund Telemetry is my site. Everybody can go check it out. I focus on market sentiment. I put out 3 notes a day. I'm in on the weekends, as you see in my office, and putting out 3 notes on the weekend. If anybody wants to subscribe, we do have a deal. If you put in the code markets, you'll get $250 off the $750 annual rate, and put that in as a code and check out. And but please reach out if you have any questions. And yeah, definitely let's do this again. And good questions. A lot going on, and it's going to be a long year.
Yeah, definitely a lot going on, and it doesn't leave us short of any topics to talk about. So yeah, we'll definitely have you on, and I'll put everything that you mentioned too in the show notes and in the comments below. So wherever you're checking this out, be sure to follow Tom on Twitter. He puts out some great tweets and everything like that. And then yeah, check out his newsletter. I know you put out great stuff as well. So Tom, thanks so much for your time, and I really enjoyed this one.
Yeah, thank you. I enjoyed it too. Thank you.